Good. We're good.
Okay. Okay. Hi, everybody. So this month I wanted to interview two of my favorite people. These are the L's of the lending industry, Linda Austin and Laura Lella, who are both mortgage originators with Van Dyke Mortgage. And I wanted to talk to them this month a little bit about some of the mortgage myths that are out there during this COVID pandemic that we're seeing. I've had lots of people asking me questions about it, and I am certainly not as well versed as these two ladies. So, ladies, thank you so much for coming on and for humoring me and for dispelling your wonderful knowledge mortgage knowledge among all of the people in my life. So, Linda Austin, I'll start with you.
Okay.
So Linda is a mortgage originator also. She does do some specialty loans. She does a lot with conventional and VA loans. But one of the things that I get asked a lot is, I hear that the rates are like zero. And so I think I should refi, or I should go buy a house because I can get like a 0% interest rate. So is that actually true?
Well, Amber, we are going to bust that myth.
Yay.
Myth number one. Okay. Well, it's true that mortgage interest rates are pretty good right now. And historically speaking, they're still what most people would consider low. They're not as low as the prime rate, the rate that you've been hearing about on the radio and on TV. The prime rate is the rate at which banks borrow money overnight from other banks. Okay, so the prime rate is dictated by a totally different market than mortgage interest rates. So right now, it's a great time, for instance, to go out and competitively shop for a car loan. It's a wonderful time to go out and get a line of credit. Those are just two examples of financial products that are driven by the prime rate. And it is low. In fact, it's close to zero. Myth. Mortgage rates follow a completely different market. There are two big indicators. One is called mortgage-backed securities, and the other one is the Treasury bond index market. Those two markets, along with some other factors due to COVID-19, are determining where interest rates are lying. And there's some big differences in interest rates for purchasing a home, and then a different set of rates for people who are looking at refinancing. Okay, so a lot of clients are getting confused between the prime rate being so low and they're expecting, as you said, those mortgage rates to be to zero. And unfortunately, that's not the case.
Well, and that's what I'm hearing. And I know this, but I am not good at explaining it when people say, oh, this is a great time to buy a house. And I'm like, well, it still is a great time to buy a house because interest rates are pretty low, but they're not as low as you think. They're not zero.
You're right.
So what you're saying is I should consider trading in Vilma the Volvo.
Yeah, or shopping for a credit card that has a 0% interest rate right now for, an extended period of time. So it is a good time to get loans, all kinds of loans, but don't get confused. The prime rate does not have a lot to do with, it's not directly related to mortgage rates. So lean into your lender and ask about what your mortgage rate would be if you're thinking about buying a house or getting a refinance loan.
Okay, so that's really good advice. Okay, Laura Lella, who I always like to call LL of lending. She also does some interesting, she's got some specialties in her field too, where she does some USDA and some FHA, and those are kind of her things. She's also very familiar with the conventional and the VA and those things. But Laura, I wanted you to talk a little bit about what you're seeing in the mortgage industry. We're hearing places like Quicken Loans and Rocket Mortgage are not even doing any loans here in Ohio. And like Chase just changed their regulation to say, well, if you want a loan through us, you've got to have a minimum of a 700 credit score. So why is this happening? What's going on? Can you shed a little light and give us a little insight on that?
I'd love to. Thank you. And I realized while we started doing this that I feel like I'm on CNN or Fox News, like where I'm like waiting during interviews. It's funny. So thank you for having me for this. I always bring the comic relief, to me. So so really what's happening is Linda said it perfectly. Rates are great. Rates are really low. they're at historic lows when it comes to when you look over the history of the mortgage industry since the 80s, 90s, early 2000s. They're right there. What we're finding though is that when people hear things like recession or stock market decreases, they automatically think of the last recession that we had, and that was driven by the housing market, unfortunately. Thank
There's
God
a movie.
this
Did you guys
time.
see that movie,
Yes.
Big Short?
Yes.
Yes.
Yeah.
Okay.
uh
Anyway, go ahead.
thank
Sorry.
No, it's okay.
So yes, the
Thankfully this
recession back
time.
then was driven by the housing industry for sure.
Yes.
Yes.
So thankfully this time around, and I say thankfully because I'm in the industry, it is not because of the mortgage industry that we are finding this. On the flip side, unfortunately, it's because many people are sick. The local governments are trying to take procedures and do things in place that will prevent it from spreading further, or and hopefully slow this thing down. And if anybody's on the call that or listening to this that has been affected personally by this, I sincerely, my heart goes out to you, and I hope that everything gets better soon. And because of these things that are being put in place, people aren't able to go to work. So the unemployment rate is super high right now. The people that are filing, these companies are putting people on furloughs or laying them off, and then people are going to file unemployment. And when that happens, if somebody's currently in processing, we can't close the loan. But what happens after it closes is that we have approved them based on the income that they were making, and now they're no longer making that. And so servicing companies are extremely conservative now when it comes to purchasing loans. They are worried that there are millions of people out there that may or may not be able to make their mortgage payment. And in turn, that would require them to, depending on the loan, make the payment on their behalf. So for like Fannie and Freddie Mac, the servicing department only is required to make the interest payment on a loan. So if a buyer doesn't make the payment, if I'm servicing the loan, all I have to pay to Fannie is the interest payment. Now, an FHA or a USDA backed loan or a VA backed loan, those are government backed loans. They're serviced by Ginnie Mae. It's another secondary market person. They require the lender to pay the principal and interest payment. So times that by 16.5 million people who don't make a mortgage payment, and somebody could go under really quick. So there are several different mortgage companies out there that are shutting their doors to purchasing loans on the secondary market and forcing people like, my company to service them on their own. And so what we're finding is that the rate is super low. We're talking in the threes at the moment. The day is for 4:15 at a little bit before 2. It could change.
Yeah.
But right now,
That's right.
it's in the threes, so it's super low, but the cost for the rate is higher. So because we're not getting paid, from a servicing department and a big package, for us to sell the loan, our companies, and not just us, mortgage companies across America are having to, put extra cost in on their rate so that they can make enough money if that person were to go into foreclosure, or not even necessarily foreclosure, but not be able to make their payment. We have enough funds to pay and pool that together so that we don't go under. And so you're finding things like Quicken, for instance, you mentioned them, they noticed that Ohio, where that's the state we're in, is on a stay-at-home lock. So they are not lending in Ohio because they know that there are many people that are going to get laid off or can get laid off. And so they're one. Chase Bank is one that hired their credit score, and that's because they're trying to slow down the amount of applications that they're getting in so that they can help service the people that they have, help the people that are approving, and they're driving their low foreclosure rate or low, buyback rate or low, not being able to make your payment, factor on their credit score alone.
Yeah.
Now, companies like us, and I don't want to get too much in the weeds, but our secondary manager, and we're not alone in this, there are other companies, they look at other factors like, do you have assets? How's your debt to income ratio? What is your credit score? But there's other factors that we deem to be key important into that. So what you might find is that there may be a requirement now for more in assets, so that there's more reserves, so that when you close, you have money set aside that if you do lose your job, you can still make your mortgage payment.
Yeah.
Things like that you'll find in play. And what you'll find on the real estate side of things is that you're probably going to see contracts come in where the seller is having to pay more in closing costs because of the buyer having to pay more in their closing costs for their rates. And so I just want to make sure I kind of briefly talk about the why behind that on the servicing side of things, because hopefully it loosens up and everything goes back to normal, but there are several companies that are just not going to make it through this. And so the ones that are keeping their doors open are just being a little bit more strict, especially with knowing that the last recession was based on the housing market. So,
well, and I'm sure they just want to take a proactive approach, not to get themselves in a situation like that was, 12
I agree.
years ago or whatever.
Yeah.
But I think it's important for people to understand, kind of like you said, the context in which this is happening and why. This is why buyers are asking for more closing costs, is because it's costing them more for these rates. And then because the rates really aren't zero, they really are low, but still they are paying for those low rates in other ways and other fees because the secondary market has slowed down drastically. So, well, this is great information and I think very helpful. So for any of you out there who are seeing this and you want me to get you connected with the L's, the LL and the L of Van Dyke Mortgage, the L's of lending, I'd be happy to make that connection. They're both wonderful people, wonderful lenders, and always very helpful and informative. So thank you, ladies.
Thank you, Amber.
Today. And wishing everybody health and happiness, and stay at home until you can't do it anymore.
Thank you.
Thank you.